Hello, welcome to the Economic View. I'm joined as always by Evan Lucas, our market strategist. Hi, Evan.
Hello, Tony. How are you?
Yeah, good. So the wages data out today, it's quite depressing. And when I think about it, if you overlay all the other factors around wages growth, company profits, some at record levels, employment levels still relatively buoyant. It's quite alarming, really, to see that wages growth is at such a slow pace.
Yeah, and it's been a trend that's been going on since 2013, probably the one you really want to look at. But there's also a clear break there as well. So breaking it down into public and private sector, public has been outstripping private all that period of time, up 2.4% year on year versus 1.9%. Now, if you take that into consideration, again, the question we're going to be probably talking about now for the next sort of 5 minutes is around inflation, right? But private sector wage inflation is basically CPI. So your mandated CPI you should normally be getting at the firm that you work for is pretty much what the private sector is getting, give or take. I mean, The argument would be that inflation is probably need to be readjusted by 0.3 of a point, which is what the RBA has said. But realistically, you can't go past. Your wages are growing with inflation. You are not getting anything else. Now, that is excluding bonuses. But in saying that, if you, again, getting back to your point about what's been going on with the business side of the sort of the economy, and yes, record profit growth is also at some of its highest levels in the post-GFC world. Business conditions, look at NAB confidence this week and NAB's business conditions. NAB business conditions were a record. It's the highest level ever, and it would beat the 2004 level, which was a 20. It came in at 21. All that's not translating into wages. And the trend is fairly linear to the downside. If you then look at it on a real adjusted value basis, quarter on quarter and year on year, that's where it gets really sad. It's 0.1 of 1% quarter on quarter. And if you have a look at it in terms of the numbers on a year on year, it's 0.5 of 1%. And that's where I agree with you. It's a really, really poor figure and weak no matter how way you look at it. But this is a known. And this is the other thing. This is what you've been hearing from the RBA, particularly over the last 3 weeks, which is really interesting. I think Guido Bell's speech even this week on Monday was a clear standout that he said there is no sort of case for raising rates and clearly wages are a problem for us. He then also points out this is not just an Australian problem. This is a global issue. Have a look at the US. Have a look at Europe. They've had even more monetary policy stimulus than we even got close to during that GFC period, and they haven't been able to wake up wages. So this is the question that they're asking, is this a structural change? Is this the new phenomenon in the developed world of low wages? Some argue yes.
We could go off in so many different directions on this discussion because obviously if wages growth is low and companies aren't necessarily investing in their businesses, as we've seen, then where's the money going? Obviously out the door in terms of dividends.
Yep.
So companies trying to maintain dividends. We have seen growth at the top end of the scale in some businesses, which is a cause of concern. So, I mean, there's so many different directions, we can go with this discussion. But overall, you'd have to say that, it's not a great picture in terms of the chart that we're going to put up on the screen here.
Yeah.
Going back to 2000, really, we saw that growth. And then since the GFC, really, wages growth has been very low.
Yeah, I'll pick up sort of smoothing that chart out that you can see at the moment. Smoothing that out, you can, because you've got to take out 2009 and what happened around the GFC, but you can see the mining boom peak inside those numbers as well. So part of the reason wages were growing so rapidly, particularly through 2004 and up to 2007, is what was going on in mining. Again, picking up two parts of your point there and picking up what Guido Bell said on Monday. The RBA believes that the non-mining sector services is going to be sort of like this white knight saviour. If you have a look at probably some of the biggest contributors in terms of this index, financial services, that area, grew at one of the most anemic rates out of all and wasn't as slow as the biggest one, which was mining. So quarter on quarter, mining only grew on their wages 0.2 of 1%, despite everything else that we've been seeing around what's been happening in mining this year and the massive increase in jobs that have been going back into mining. there isn't a movement in the wage side. If you look at financial services, and that's a big broad brush across that sector they have there, 0.3. So two major sectors that really do put inflation points into that wage index are really, really lackluster. So then you've got to go back to, okay, services as a whole, that's everything, education, health, public sector to some point, want to discount that slightly. All of it is in the one direction. And again, that's right. So picking up your point around the business side of it, the interesting thing is that with a services-based economy, your investment in your company, firm, what have you, is actually back into your people, because that's where R&D comes out, research and development. The actual sort of selling of your services comes through your people. And this is the question also, and this is why we can go off on huge tangents. Digital disruption is the part that you're now hearing a lot of people sort of finger as the reason behind the investment, where it is going. Yes, shareholder value. Yes, short-term opportunism. Yes, also cost-cutting is part of it. But the funding that is being put out, because have a look at the CapEx numbers. CapEx is expanding, or at least forecasted to expand next year. That therefore means that businesses are spending, and they're spending it somewhere. Where is it going? It's going to digital. And this is the other thing, is that the argument can become quite theoretical and philosophical, which is, are we starting to spend more money on robots than we are on ourselves? And that would be the next conclusion. But bringing it back to what we do, again, RBA would be disappointed with this, considering what they said in the statement of monetary policy last week. They clearly are telling you that because of where wages are growing, inflation's a problem. The next part of this is consumption, and this is the next part of the discussion, is that consumption still makes up roughly between 40-42% of GDP. If your wages aren't growing, your level of consumption is going to go with it. And that's the next part for the RBA as well, is that the GDP figure will be under pressure if inflation falls off.
Now, just a last point before we wind up, but really this says that rates can't go anywhere, in this sort of climate.
Mm-hmm. And I'd agree. And not only that, the theory that sort of came out, particularly at the end of September, August, was that 2018 was really positive and rates are going up. And you got two big retail banks, ANZ and NAB, putting out reports saying that that's the likely scenario. Not only can it not happen with what's going on, there will be more and more signs that realistically, if there is going to be movement, and I'm actually suggesting there won't be, but if there was a movement, at the moment, with the stuff that we've got in front of us, it's more likely to the downside. It's more likely a cut than it is a hike. I personally don't think they're going to move rates in the next 12 months. The market says the same thing. There are some arguing that they're not going to move rates out to December 2019. And again, there is reasonable cases for all of them. I think the most central point and the most sort of consensus view is that rates can't move. Like the economy just is too finely poised. Almost, it's not Goldilocks, so it's not perfect. It's probably to the downside, but it's so heavily poised in certainly both positive and negative areas that there's no reason to it. And there are other natural levers in the market that are causing tightening in housing, loosening in certain other areas. So the RBA is out, and I think that's been the conclusion. And then the final part of this, bringing it back to a market's perspective, the Aussie dollar is key for next year. I think we've talked about this before. The Aussie needs to be lower because next year will be again about growth stocks, and most of our growth stocks are US denoted in terms of their earnings. So a tailwind would be great by an Aussie being lower, and this wage index again just equals up everything we just talked about, RBA, etc., etc. It's trying to break below 76 cents, and I think that is likely to happen now with all the data that we're getting.
Thanks, Evan. We'll leave it there for today.
Thanks, Tony.
Join us again next time on The Economic View.